Hi, I'm Linda Eedes. This is an update on the RECM Global Flexible Fund, looking at the first quarter of this year, talking to some of the changes in the portfolio, some of the drivers of returns over that time, and then discussing very briefly how the Global Flexible Fund is currently positioned. So looking at the first quarter of this year, it was in fact, if you look at the index returns, it was a very buoyant one for local investors as well as global investors. So all of the concerns during the fourth quarter and pessimism was very quickly shrugged off, and the markets had this huge about turn. If you look at the S&P 500, it was up almost 14% year to date. Our own market was up 8%. But if you actually look at the drivers of those returns, particularly domestically, you will see that that was actually driven by a very narrow group of stocks, namely the sort of more rand hedge, large cap type stocks, which are more sort of tied to the global cycle. So some of the resource counters and the likes of Naspers, which benefited from this huge kind of uptake of technology stocks. Naspers was up 19%, stocks like Richemont were up 12%, and in fact if you take the top 5 stocks of the all-share index, that actually accounted for 90% of the 8% return we saw from the all-share index. So it wasn't a very broad-based recovery, and in fact if you look at the local counters and the more sort of locally focused businesses, they actually didn't benefit from that massive turnaround. But certainly globally, across the board just about, looking at developing economies, emerging markets, there was a huge rally across the board. So it was really the offshore exposure in the Global Flexible Fund which saw it delivering a positive return during the first quarter. The fund was up 3.5% after fees to the end of March, and that was mostly, as I say, due to the fact that half of this portfolio at the moment is offshore. So half the portfolio is invested in areas such as the UK, where we are seeing value opportunities as a result of the uncertainty around Brexit. Interestingly enough, despite the toing and froing on that front, the UK market also had a very buoyant time. So stocks such as Tesco were up, in fact, more than 20% during the quarter. This fund obviously benefited from that. That's one of the biggest stocks on the global side. But we do still hold quite a bit of cash on the offshore side of the portfolio. Locally, some of the contributors would have been Impala Platinum. After languishing in the doldrums for a very long time, platinum producers have been showing some signs of life as far as their share returns go. In fact, Implats, which has been a laggard up until now, was actually up more than 60% over the quarter. The portfolio does have some exposure to Richemont, which was, as I say, up strongly, and again Tesco and other UK counters which benefited from the rally there. On the detractor side, of course, those local businesses that we have exposure to, such as Stefanuti Stocks, HCI, Avenge, Clientele, Lewis, all of those types of businesses were actually down during the quarter. So over the last 3 years, the fund is still doing well. It's up 5.8% per year after fees, versus the average of the category, which is of course the worldwide multi-asset flexible category. And the average of that sector is actually 4.3% per year. So 5.8% is quite a bit above that. And in fact, this fund, which we've been managing since 2003, is achieving its objective of delivering 6% above inflation per year over the 13 years that we've been managing it, or in fact 16 years. So looking at the changes during the quarter, we had a few new stocks coming into the portfolio on the local and global side, small positions, but all to very much value situations. On the local side, that included poultry producers such as Astral Foods, Quantum Food, and printing company Novus Holdings. On the global side, we introduced positions to some of the tobacco producers. It probably won't come as much surprise that we're starting to see tobacco producers being on the value side of the equation, and our preferred entry points there are Philip Morris and Imperial Brands. We also introduced an allocation to French car manufacturer Renault. Renault is actually trading at a 3 times PE multiple at the moment, if you look at historic earnings. What that basically implies is that the market's saying that it's going to produce another 3 years of earnings and nothing beyond that. Is a way of looking at it, which of course we believe to be completely ludicrous. There is a lot of negative news around the car industry at the moment. It doesn't help that new vehicle sales in China dropped for the first time in 2 decades. And that is very much playing into the multiples that you can buy stocks at in that sector. In fact, if you look at Renault and its 43% stake in Nissan, you don't have to be too optimistic in your assumptions to get to a point where, in effect, you're buying their stake in Nissan and you're getting the entire car manufacturing sort of operations on the Renault side, as well as the car financing side of Renault, entirely for free at current prices. So we like that kind of proposition. And the portfolio is really made up of a combination of very, very different stocks, which all have two things in common. They are undervalued at current prices, and they tend to be good businesses, which makes for a very robust portfolio if you can include as many of those kinds of ideas which are uncorrelated and driven by different things, and which tend to be very robust as well during times of market decline.